We're going to get to our market recap, our wrap the week segment in just a moment, but I wanted to start with a poll. We asked you recently on our StockCharts TV page, also on YouTube and on Twitter, which sector performs the best between now and June 30th, 2021. 4 choices: energy, financials, technology, consumer discretionary. What strikes me with the results of the poll, no real clear favorite. All of them got at least 20% vote. So at least 1 in 5 of you voted for every single one of these. So it shows you, I think, if you're looking for indecision and no real clear path forward, I think we're getting that. What this could also mean is people are sort of expecting everything to work okay. The top vote getter, right? The most frequent response was technology. And I get the argument for that. We're going to start there here in a second, and then we're going to switch to some other things. But, when you look at the technology sector, when you look at the Qs or the NASDAQ 100, I have the NASDAQ composite here. It is tempting to think of this as something that is sort of finding stabilization, has had a nice rally, has pulled back, it's finding support, it's maybe making a higher low yesterday, and today was the follow through to the upside, and the tech-heavy NASDAQ composite pushes to new all-time highs above 14,000 for good and goes further on. I totally get that thesis, and Tom Boley, one of our fellow contributors and SCTV host, does a great job of articulating that thesis, sort of this rounding pattern and the potential for moving upwards. For me, I'm as always, I'm either a bear or I'm a skeptical bull, is how I would tend to describe myself. I tend to question markets going higher, especially when you have divergences. And so when things are moving higher on weaker momentum, that concerns me. That's the pattern we saw last month on the NASDAQ, on semiconductors. That's the pattern we've seen now this month with banks and energy companies and all of that. I don't know if we've seen enough of a pullback to justify or to unwind, to validate that that sort of reversal lower. We're going to get to the wrap of the week here in a second here, but I did want to spend time looking at one more item, which is the Dow Theory, right? Depending on how, again, I feel like there could be some more backing and filling some more corrective patterns. But having said that, I am seeing so many signs of a healthy market. And I think overall, I would argue, I think the market long-term is going to do just fine. I think the question is, are we accelerating from here, or are we pulling back and building up steam for the next move higher? And Dow Theory would tell you that things are just fine, right? The Dow Industrials making a new high today, the Dow Transports making a new high today. On a chart where at the end of the week, both of these have made a new high, that is not the time to be too bearish. That tells you that there are plenty of stocks across the sectors that are doing well enough to push these two indexes higher. When those things stop going up, or at the very least, when one of them does not confirm, we get a Dow Theory non-confirmation, that's when we want to start getting super concerned. Same thing you could say about breadth, which we'll talk about in a few moments. Breadth overall holding up pretty well. Let's do our wrap the week segment here. We're going to look at just the weekly changes in some of these different assets, and again, a lot of things evolved very quickly at the end. Here's where things sort of settled in. The S&P 500 at the top of the list, that's here. It's here in black, and I didn't get the labels on here, so sorry for that. I'll walk you through them. The S&P finishing the week now up 1.7%, and everything else was below the S&P. So really owning just the market, right? Owning equities was the play at this point. Second were bond prices. So stocks and bonds, the S&P and the TLT were the two top performers out of all the things in our asset allocation list. After that, you had the Qs up 1%. You have the dollar up 0.8%. That's using the UUP. What was below zero today? What had a negative return this week? Gold down 0.6%. Crude oil prices using the USO also down about 0.6%. Emerging markets down 1.5%. Small caps down 2.6%. Now you can see most of that came Monday, Tuesday, Wednesday. You can see Thursday and Friday. Small caps are actually the best of the bunch, if not the very best, one of the top couple. So certainly that was the story this week. Bitcoin was actually down here. I took it off that previous chart. It actually was down 7%. I think, the chart of Bitcoin, it in some ways, it's very much a topping pattern where you have this big bearish divergence similar to what we've seen on a lot of the equity charts, but jumping up pretty good today. It was down about 11% yesterday and came back up to finish positive today. Very quickly, I just want to check in on where everything else settled in. Small caps led the way higher, really spent most of the day at the top, up 2.4%. The VIX is back below 19 now, which is one of the lowest readings we've had in over a year. Bond prices down about 1/3%. 10-year yields back up to 166. Gold and silver mixed, so sort of a mix from precious metals. Bitcoin today on Friday up over 5%. Ethereum as well, and all the other cryptos that we tend to follow in the green. Very quickly check in its sectors, and then we'll go to our Mindful Investor Live chart list. Technology, energy, materials, real estate, all strong today. And technology has not been at the #1 seat for quite a while. A very few days I can think of off the top of my head where tech has been #1, but that's what we saw today. On the downside, communication services, which is interesting because that's been one of the best sectors up until that's been, one of the better stories. And my guest yesterday, Doug Bush, was focusing on communication services, finding some decent charts that have some upside. The issue with communication services right now, you have a lot of names that had incredible runs, and things like Viacom, Discovery gave back a lot. VIAC in particular was probably one of the worst names anywhere. It was down over 30% at one point, got just below $40 a share, back up to 48, but that's after a downgrade and other things. So overall, really some weakness on some of those entertainment names, which had been really, really extended after really, long established runs. Let's continue on with the Mindful Investor Live chart list. If you've not seen this before, we review it every Friday. We'll get through as many of these as you can. If you want to access this list on your own, go to the articles tab at the top of StockCharts. Go to my blog, which is called The Mindful Investor. You'll see at the very link at the very top a link to access this particular chart list. Starting off with the market trend in the S&P. So I update this every Friday after the close. At this moment, you have a similar, you have the same reading that we had last week. Long-term trend is bullish. That turned positive in early June of last year and has remained positive. That seems absolutely right. The medium-term model still bearish, so still below zero, and that turned negative mid-February and has remained negative. So it's interesting that you have a divergence between price making new highs and the medium-term model being negative, but that's what has happened. The short-term model has been positive for the last 3 weeks, indicating a short-term rally. And as I've mentioned in the last couple of weeks, that's about how this market feels to me. I think the long-term trend, absolutely, when you're this close to all-time highs, it makes sense that it's positive. The short-term model being positive, I get it with the bounce that we've had in the last couple of weeks. The medium-term model being negative, I think, indicates the weakness that you've seen with the pullback, right? The tactical pullback that you're seeing in a lot of names in a lot of sectors. What we saw today was a potential resumption of that uptrend, and I think that's going to be the story, is whether or not, if we get a follow through next week or not in a shortened holiday week. The S&P really close to making a new closing high. It actually might have done it. It's really, really close right there. I don't think it quite did. I think we were a little bit higher about a week and a half ago, but very, very close to that 4,000 level for the first time. And that will certainly be a milestone to note. I think I'll be very focused on this RSI level. We closed the day around 59. That's very close to what we saw at the most recent S&P peak. The story for me for the last 2 months is that you've had lower momentum on higher prices. Does that change this time? Which would certainly change the configuration of the price characteristics and momentum characteristics. Breadth overall has remained positive. I mentioned that earlier when we're looking at the Dow Theory chart. That's pretty strong. This breadth chart is also very strong. And again, I learned a long time ago, never be too bearish when this chart keeps going up. And again, it's the S&P at the top, and then it's the cumulative advanced decline lines for 4 different buckets. And the small cap advanced decline line was probably the weakest of the 4, but remained above its 50-day moving average, keeps making new highs and new lows. Until that stops happening, it tells you overall the market is in decent shape. Looking at the new highs, they've come off quite a bit in the last week. Look at last week with the number of 52-week highs. Look this week at the number of 52-week highs. Now, this is not updated yet for Friday's close, so this could look a little different going into there, but certainly leading into today, you really didn't have a lot of stocks moving higher. That's after previous weeks where you had, a decent number. I mean, this was 15 to 20% of the S&P making a new 52-week high on a given day back here. Down here, it was less than 5%, right, making a new 52-week high. So a healthy bull trend, in my opinion, a healthy bull market making new highs has this number increasing. It's more and more stocks making new highs as well. It shows you that there's broad participation stocks able to eclipse their previous swing highs. We have not seen that yet. That's something I would very much be looking at going into next week. So this is actually bouncing higher a little bit. We saw this last week when we were reviewing this chart. This is the percent of S&P stocks above their 200-day moving average, around 90%. We have about 76% of the S&P above its 50-day moving average. Again, this is updated through Thursday's close, so not yet through Friday. But overall, you can see that this is starting to make a new swing high. So it's indicating that there are plenty of companies, plenty of stocks that are regaining their 50-day moving average. What concerned me back here in February was that you had the market going higher, but less and less stocks getting back above their 50-day after pulling back. Now we're actually seeing more and more stocks are able to do that, which is actually a bullish indication. The AAII survey, we talked about sentiment on Thursday's show. So if you missed that, we dug a little deeper into some of these themes, things like the VIX being below 20 and what that means. Things like the AAII survey being over 50% bullish. That is a fairly rare occurrence. What I'd call euphoric bullish sentiment usually is not a good sign for stocks. However, that's not always the case. And so a spike in bullish sentiment overall just tells me to be on heightened alert for pullbacks and look for signs of euphoria unwinding. And that's what I'd be looking for now. The name exposure index also we touched on yesterday, so I don't want to spend any more time on that, but check out Thursday's show if you missed the discussion there. Looking at consumer discretionary versus staples, this is one of those times where the two are diverging. So the cap-weighted version sloping downwards, the equal weighted version sloping upwards. And what that means is that Amazon and Home Depot, some of the larger consumer discretionary names, most likely are struggling relative to others. That's what makes the cap weighted version come down, but the equal weighted version hold up. What's interesting is in consumer staples, I actually saw a number of pretty decent trends. Things, CODY is one of the top ranked large cap names. I think it's number 2 behind TripAdvisor. As of the close today, we'll have to see what happened as things accelerated to the upside, but decent chart, and that's in consumer staples. So check that sector out if you haven't in a while. There's some names that are actually pretty interesting that are starting to work, but the average stock certainly not. Semiconductors relative strength has turned higher, and that's actually a really good signal if you're bullish. We saw the breakdown below the 50-day moving average for the first time since back here, which was last September. Really a negative sign when semiconductors are underperforming in general. Semiconductors do well, and the economy overall, things are doing pretty well. This was a big rotation out of semiconductors for about a 3-week period from mid-February down to early March. That so far has now gone back higher. And as of today, with a further upside, you're seeing this ratio go higher. I'm thinking of charts like AMAT, Applied Materials in that sector, making new 52-week highs, new all-time highs. Decent chart, not yet overbought, new relative highs. So there's some good charts to pay attention to there if you miss them. But again, I certainly want to see the semiconductor ETF continue to improve if I'm going to feel good about things. Small caps have come off versus large caps. The question I've been pasted at the end of small cap leadership, I don't think so. I think this is a choppy digestion period that we're in after a lot of small cap names had a lot of really good runs, particularly in financials and elsewhere. So we'll see if that comes off. Same thing, equal weighted S&P came off, but that is breaking out a little bit to the upside as equal weighted stocks. I'm sorry, as the mid cap part of the S&P is doing better. Finally, I want to hit on the U.S. versus the world. We have a stronger dollar environment. We'll hit on that chart in a little bit. The U.S. versus ACWI, so the U.S. market versus the entire global markets continuing to go higher. So in general, better to lean away from things like EM overall and into the U.S. is what that ratio is telling me.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.